We'll see you again. So we're going to dive into an example now of the alternative deal structure to a leverage buyout. So this model here will compare an LBO structure with the buy, build, sell structure. So this is a live example, and this tab here, the data tab, just purely populates key data from their accounts. Okay, so we've got P&L, turnover, cost of sales, gross profit, operating expenditure, operating profit, interest, tax, depreciation, amortization, and then we can calculate the EBIT, earnings before interest and tax, EBITDA, earnings before interest, tax, depreciation, amortization, profit before and profit after tax. So we can see in this example, this business has 5.7 million of turnover currently. Its operating profit is just over 1 million. Its EBIT is 960k. Its EBITDA is just over 1 million, and its profit before and after tax is 945k and 701k respectively. We then have over here key data from the balance sheet. So we've got their fixed assets, their current assets, their current liabilities, their long-term liabilities, and then that gives us the net asset position, and we can see what the balance sheet of the company is worth. We've also separated out here hard assets. So these would be assets that aren't really used in the working capital of the business. So for example, in this scenario, the business owns some real estate, maybe it's the premises that they trade from, and it also owns some plant and machinery because this is a manufacturing business, so it manufactures stuff and needs big machines to make the stuff that they sell. This more is a working capital assets. So we've just got the hard assets here of the real estate and the plant and machinery, and the reason we've got that is because we're going to look at those assets in the second deal structure, not in the LBO structure, and how we factor those into the deal. We've then got some free cash flow calculations here. So we've taken EBITDA, just over 1 million, the interest the business is currently paying, its tax that it's got to pay, any capital expenditure that's forecast in the business. So when you take off those payments from the EBITDA, and that leaves free cash flow of 711k. So in a leverage buyout structure or any structure where you're using debt, that's quite a key number, because ultimately that's what your free cash flow is, to be able to service any debt repayments, capital repayments, or interest on any debt that you take on as part of this structure. So very, very key number, particularly in an LBO, because that's basically what we've got to play with to try and structure a deal. So we've then also got some just very basic working capital calculations. So we can see here debtor days, creditor days, and working capital. Debtor days are effectively the debtors. So this is the amount of money that customers owe the business. So in this example, 1.1 million. You divide that by the turnover, 5.7, and multiply it by 365 days of the year. That gives us, in this example, 75 days. So it's taking on average this business 75 days to get paid from when it raises the invoice. And then on creditor days, we take basically creditors, we divide that by cost of sales, multiplied by 365 days. That gives us an average of 79 creditor days. So effectively, this company, when it receives a bill from a supplier or a creditor, it's taking them 79 days to pay that. Working capital, there's many different ways to calculate working capital, but a very crude way would be to take their current assets less their current liabilities, which gives us a working capital figure of 1.25 million. When we are putting a deal together, we would always look at that in a lot more detail, but just from a very basic deal structuring point of view, that's just a crude measure. So in an LBO structure, we've basically taken a 3-year average of EBIT. So in this example, it's 980,000 is the average EBIT. So we're going to base the deal on that. We're going to pay a 1.5 times multiple. We've then got the net assets, so what the balance sheet is worth, of 2.1 million. So effectively what we're doing here is we're adding the balance sheet to 1.5 times the EBIT, which gives us a total valuation to buy 100% of the company for 3.6 million. We're going to pay 1.1 million at closing. Then the deferred considerations, the seller financing is 2.4 million, which is payable over 5 years. In terms of how we came up with that up front, we've basically looked at the assets on the balance sheet, and here we can see we've got invoice finance. So there's 1.1 million worth of debtors, so we could borrow 70% of that, which would give us 823k. The real estate's worth 550. We're going to borrow 50% of that on a commercial mortgage, gives us 275k. And the plant and machinery is worth 475k. We're going to borrow 70% of that, which gives us 332k. So the total amount that we can borrow is 1.4 million. And Then out of that, we need to pay professional fees, so lawyers, accountants, lenders, etc., brokers maybe, which basically means that the seller can have an initial payment of the 1.1 million, which is where that's come from there, which is basically the 1.4 that we've raised, less 250k of fees, leaves 1.1 million. Then we're going to look at how much this costs us to service. So interest on the invoice finance is 120k. There's going to be an arrangement fee initially of 75k. There's not going to be any capital repayment here because it's just going to be a revolving facility. On the real estate, the interest every year is 23k. There's a 25k arrangement fee, and then we're going to pay 11 grand off the capital because this is over a 25-year period. Plant and machinery, exactly the same, but it's just done over a shorter period of 5 years. So we can see in year one, the interest, the fees, the capital repayments total 349k. So that's what it's going to cost us in year one. Year two, there won't be the arrangement fee, so it's just going to be the 171 and the 77. So our year two debt servicing on the external debt is 249k. So remember that initial cash flow, the free cash flow in the business is 711k. We need 350k of that in the first year to service this debt. And then in the second year, we've got 250k. So that leaves roughly 450k left over towards the seller in terms of paying deferred consideration. Then we'll just look into the free cash flow model of the LBO. So basically, we've taken the most recent data that you've already seen, the turnover and from the P&L. So exactly the same data as what you saw here. And then we have basically done a forecast for the next 6 years. So we're basically putting here growth. We're forecasting 5% growth every year, and we're forecasting inflation and costs and salary rises initially 2.5%, but then it rises to 3.5%. So that then basically gives us a calculation of what the free cash flow is every year. So we can see here in 2024, it's 759k, 2025, it's 820k, so on and so forth. We've then got here the debt servicing. So we've got a little bit of capital expenditure forecast. You can see here we've built in the debt that's being pumped into the business. We're putting obviously what the current cash in the business is, less the fees to do all of this. That's the day one seller payment. And then every year we're going to pay this deferred consideration of 494k. We then have the debt servicing, which is basically to the bank. So this then shows us what the free cash flow is after all of that. So in year two, it drops down to just 15k. Year three is 31, so on and so forth. And then obviously once the seller is fully paid off, the free cash flow then jumps back up. And we can see that on a cumulative basis. So it's, basically the deal's viable. This is the debt service ratio cover, which is effectively the operating profits divided by all of the debt servicing. So that gives us a number there, and we want that number to be north of 1. And most of the banks tend to operate on a sort of debt service ratio of 1.3 to 1.5. So in that example, as I've said before, we're going to buy the business, all of it for 3.6 million, paying 1.1 at closing. We're going to pay the deferred over 5 years, which is 2.4 or just shy of 500k a year. And it's costing us, the best part of, in this particular example, we're paying the bank 1.8 million. We're paying the bank 1.3 million over that 5-year period. We're paying the seller 2.4 million. So yeah, incredibly expensive, but obviously you can see there that that is a way of doing a leverage buyout and how this could be possible. So if we look at the buy, build, sell model, and we'll then compare the two in a moment, we're still using the 3-year average EBIT, which is 980k, but because we're going to be more flexible in this deal and there's no external funding, we're going to pay a higher multiple. So we're going to pay 4 times in this example. We've then got those hard assets that we spoke about before, which is the real estate that they own and the plant and machinery. And then we've got the free cash, which in this, you'd have to do the working capital calculations. But in this scenario, if we just go back to the data, we can see here they've got just shy of 800k in the bank. And we're saying that half of that is surplus to working capital requirements, and the other half we can pay out as part of this transaction. They already have some debt in the business. So effectively, the way that we've come up with the valuation is we've gone 4 times EBIT plus the hard assets, which gives us a valuation of 5.2 million, which is 1.6 million more than we were offering in the LBO model. So we're going to purchase just 80% of the business. In this example, we might buy 70%, we might buy 80%, but the example here is 80%. So for 80% of the business, we're going to pay just shy of 4.2 million. At closing, they're going to take the surplus cash as the down payment, which is the 399k, which then leaves deferred consideration of 3.8 million. We're still going to pay that over a 5-year period, but we're actually going to give them the interest. So rather than pay the bank like we are in the LBO model, because they're effectively financing it, we're going to pay them some interest instead at 8%. So they're going to retain a minority stake of 20%, and they're going to come on this journey with us, and we're going to build a group, and then ultimately we're going to sell. And the idea is that their equity that they've retained when we sell the group will be worth further consideration. So exactly the same free cash flow model here for the buy, build, sell model. So we're growing every year at 5%. We've got the inflation at 2.5%, driving up to 3.5%, and then that gives us what the free cash flow is in the business here. And then we've built in here the deferred payments that we're going to pay to the seller, so 760k a year. And then we've got the interest that we're going to pay them on all of that here, which basically means that we're basically paying them instead of the bank, and they're benefiting from that. Why would a seller want to do that? Well, effectively, there's a number of reasons. Number one, they're getting a high multiple. The reason we can pay a high multiple is because effectively, for the privilege of them acting as the bank, we will compromise and offer them a higher multiple, and it gets them that higher multiple. Probably most business owners have already made their money, so I'm not saying they're going to give the business away. They've probably already got the nice house, the nice car, the lifestyle, the savings, whatever. So effectively, when they sell their company, they were probably going to just invest the monies that they would get from the sale into some sort of investment, whether that be buy-to-let property, stocks and shares, whatever. They were probably likely to invest most of that. So effectively, you're then creating this income for them, because we're basically paying them every year 760k in consideration, and we're paying them 608k's worth of interest over that period, which is likely to give them a much better return than maybe doing a buy-to-let, for example. And also, more importantly, one of the concerns that sellers have, particularly in an LBO model, is the security for the deferred payments, because the bank is going to take the first charge. So they're going to sit behind the bank. So in the event of some sort of default, the bank is always going to take priority. So in this scenario, because there's no bank involved, they can take the same level of security that the bank would have. So we can give them a fixed charge debenture, maybe a share charge, until such point as everything is paid. A great benefit from our perspective is that because they're still retaining a share, they're going to stick around, they're going to come on the journey. We're going to benefit from their expertise to help in building that larger group. And of course, because they are a shareholder and have a vested interest, this structure, they're likely to grow the business because they're still going to be very focused on it. Not factored into this particular model, but other things that we can do that make this interesting for them is that we could give them preference shares, so that the 20% that they retain could entitle them to dividends, and we won't be entitled to any dividends until such point as we've paid off all of that consideration. So not only can they get paid for the 80% and the interest on that 80%, but they could also receive dividends as a priority over ourselves, which potentially could sweeten the deal as well. Now, this is quite an interesting one, because we've then taken the EBITDA for the next 5 years that we're forecasting, and we've applied a 5x multiple, because part of a larger group, this business will be more valuable. So let's say we sell at 5x. The overall business could be worth 7.1 million by the end of that 5-year period, and their 20% is worth that 1.4. So if we do a very quick comparison, in an LBO, we were going to pay 3.6 million. We were going to pay them over 5 years. That's what the debt servicing is to the bank. And obviously the equity valuation in year 5 is 0, because we bought 100% of it. And that equates to a 3.7x multiple overall. In the buy, build, sell model, we're going to pay more. We're going to pay 5.2 million for 80%, which is the 5.3 that the business was valued at. They're retaining 20%, still paying them over 5 years. the equity valuation at year 5, we're saying that that's likely to be worth 1.4 million. So the total that they'd receive once, not just from the initial consideration for the 80%, but also for the once we sell the overall group, is 5.6 million. So they're effectively getting 5.75 times multiple, which is an uplift of almost 2 million in this example, or 54% more than they would have got in an LBO model. And you can present this deal, and you can actually present both things. You can explain, we can do an LBO. I can service that initial consideration of 1.1. It's going to take me 5 years to pay, and you're going to have to sit behind the bank. And that's why we can only pay 3.6 million for the business, because the banks will only allow us to borrow so much and stress the business in terms of debt service coverage. But if you're willing to play the role of the bank, we can get you basically 54% more for the business. And it's going to, whilst we've demonstrated this all over 5 years, it's likely that we'll buy a load of businesses over the next 12, 18 months. They'll then integrate them into the group, and we'll look to exit from some point within 18 or 30 months. So 2.5 years maybe as a maximum. And obviously at that point, if there is still any deferred consideration outstanding, then that would be settled. So in reality, this would actually get them more money in a shorter time period. So hope you found this video useful. If you're interested in doing deals like this, you can joint venture with us. So please do direct message me through the school platform, our Dealmaker community, or via LinkedIn, and I'd be happy to chat with you, and we can see how and if there's a way of us working together and pursuing leverage buyouts or this alternative deal structure.